Let's look at GPC. What is GPC, Paul?
Genuine Parts Company. X there on profit margin. They pay a 3% dividend. So with a company that's dropped so much, we want to make sure their dividend is sustainable. So the big factor here, they're a $15 billion company. It spends about $450 million a year on their dividend. That's something to keep in mind. So XX so far. Revenue growth, check mark. Big jumps here with their acquisitions. What's the deal? They had 9,200 stores. That might be hard. Who knows?
How about profit growth? Pillar number 4, Paul. Pillar number 4 is profit growth.
X. It's down over the last 5 years. Number of shares outstanding, check mark. 152 to 145.
Current assets over current liabilities is pillar number 6.
7.4 versus 6. So check mark there.
Nice. How about free cash flow growth, Paul?
1.05, 780, 660.
780.
So 0.78, 1.05, 0.78, 0.66, 0.9, and 0.6. What's that?
It's 4 divided by 5 is 0.8.
0.8 times 20. It's selling for less. It's selling for less than the number, but this is parts, guys. This is automobile parts. Companies sell over 9,800 stores worldwide, most of which are independently owned. So anything in retail, guys, it's specialty retail, which is good. You want to, their gross profit's 35%. You want to understand what they're doing. Let's see their quarterly sales compared to last year. Oh, actually not that bad, not that far down.
Make sure you guys are smashing the like. We love you watching. It's incredible. Thanks, guys.
Massive loss in the second quarter, which in the second quarter of the year, which makes sense. Yeah, this one's interesting. What was the average cash flow was 800 million and their dividends 450. So the cash flow was decreasing, I think, wasn't it? Or was it increasing? It was decreasing. So that's something to watch out for. The cash flow is down 30 or 40% in the last 5 years. So maybe you pay a multiple much lower. Maybe you got to buy it for like $10 billion as a company or something like that. Because the cash flow is decreasing in an already hard market with a very big footprint. It's going to be very difficult to get out of that problem. So this is what I'd be cautious on. I'm not saying avoid it, but with retail, with the low profit margin, such a big footprint, and it being an automotive, it's kind of hard. Of course, there's no yes or no, just from the qualitative aspects have to be understood completely.